Hello, everybody. Welcome to All-Star Financial Webinar 2017 first quarter. Our title this quarter is representative of our newsletter. Is the Trump card enough to keep markets moving? Very, very good question. As you guys know, our newsletter in the upper right-hand corner has Bob's Corner. I like to speak to different areas of what's going on and an issue, perhaps. What we thought would be really relevant is to continue on the pace that we had and the track that we had for the fourth quarter newsletter, and that's all of the uncertainties. Give you a few updates. We think tax reform is probably baked into the market. Trump's infrastructure plan probably also priced in. The Fed monetary policy, we believe those two raises over a very short period of time. We hope they don't have a third and a fourth too quickly because the bond market's not pricing that in. Dollar strength, the internationals have been helped with the weaker dollar, and the growth opportunity internationally is still there as investors are finally looking at cheap valuations. But what we want to do is be thankful as All-Star Financial about reduced volatility as a mode of operation. And one of the things we brought to the table that you may or may not know is that we've taken chips off the table and rebalanced here at the end of the first quarter when we believe the market's pretty high. So real quick in market overview, is the Trump card enough to get us through and the markets moving forward? We think if those scenarios are passed, it's probably going to be the market can move forward. But again, their repeal and replace, we found out there, hey, that if things don't get done, the market's going to come back down. Infrastructure spending, we feel, is going to be a big positive. Interest rates are going to be key, and these are things that we have no control over. The monetary policy is done by the Federal Open Market Committee, but the markets, I think, will react to too many too fast. And again, international markets, we think, as an overview, very favorable allocation or valuations. Emerging markets, as a consequence, we're up 11.5 and outperformed the domestic market pretty significantly in Q1. If we look at the U.S. economy and we say, okay, what has driven this growth that continues to be unabated, seemingly, we can point that, hey, the numbers look pretty good. Family housing, 16.5% year over year positive. New home construction up 6%. Employment continues to rise. Unemployment obviously down. Private sector earnings are up 2.8%. And for the first time in many years, debt is up, which means the consumers are feeling better about themselves to take on a little bit of debt. We have 240,000 new jobs on average per month for the first quarter, so that has caused some rebounding of our inflation potentials. So when we look forward and we're looking ahead, interest rates on the short term have risen, and those interest rates have risen three times in the last, been raised 3 times in the last 15 months, 2 times in the last 3 months. You know, the big question for us is that appropriate, and is the economy strong enough to warrant those raises of interest rates? And again, time is only going to tell. The bond market, however, says that the raises in interest rates are only about about 50 basis points more to what is really valued there. After a 30-year decline of interest rates, bond prices have risen a little bit. They came back down after the failure of the health care bill to get passed. So interest rates really on that 10-year treasury are a big deal. That's what we look for. And we saw an aggregate bond index of 82 basis points positive and the government bond index of 68. So that means overall the interest rates went down in the first quarter of 2017. Looking ahead, you know, are rates going to rise as fast as they have now after a 3-decade drop? Big question is how fast and how far. And again, what we believe is that it's gone fast enough now. Let's prove the economy can sustain that. And it usually takes about 7 to 8 months before the economy really bakes in those higher interest rates. And remember, interest rates on the short end are going up. long-term interest rates and 30-year mortgages aren't going up that much. So we think that's going to be a flattening of the yield curve. Long-term rates will stay low. And then what's the rest of the world doing is also a big thing for us. And we want to make sure that when they're decreasing interest rates and we're raising interest rates, that doesn't hurt our economy too much. It would be nice to have a common raising of interest rates theme across the world, which maybe we'll get to. Domestic stocks. When you look at domestic stocks, my gosh, we've reached all-time highs on every major index, 7% gain. Just in the first quarter of this year, the Dow plus 20,000, the S&P 500, 110 days of no decline of 1% or greater. We saw large caps outperform small caps, growth outperform value, financials, technology, and healthcare all beating the market domestically, and international was a failure, obviously, with a negative, or energy was a failure with a negative 6.5. But looking ahead, the investor optimism, can it keep pace with the valuations is a big concern for us. We look at valuations right now through the rearview mirror, earnings-wise, almost 25 to 1, when it's typically 18 to 20 to 1. So it's getting a bit pricey. When we look at global markets, one of the reasons the global markets rebounded as much as they did from a fourth quarter slaughter is that the pricing is very, very good. Foreign markets outperformed again on the international side, emerging 11.5 on the developed international side, about 8%. And looking ahead, investors are beginning to realize that PE ratios, price to earnings, what you have to pay for every dollar's worth of earnings, is pretty doggone good in the European countries. France, Germany, Spain, Italy, they're all significantly cheaper than 25 to 1. China in particular is really cheap, and that bodes well for the emerging market countries going forward. So in summary, what we talked about is we really think that investors should continue to prepare for uncertainty, because there's so much of that, obviously, both political and monetary and market-wise. Whether the government is spending money or Trump's policies are being passed into the scenario, economic data is still coming out strong. But there's always that last thing that we want to talk about right now, and that's that 9-year bull market that we've experienced, fourth longest in the history. So we need to be concerned about that. Diversification really, again, is the key. We took chips off the table at the end of this last quarter as a consequence to that. So we have more international than we've ever had before relative to our domestic stock market. One of the reasons we have that international is that we saw a great climb in the fourth quarter, outperforming 11% on the emerging, 8% on the developed Europe, and only about 5% on the average domestic stock. But look at these numbers. Long term, the domestic market has gone up over 245%. At the same time, the internationals, as measured by Europe, has only gone up about 92% or 97%, and emerging markets have only gone up about 90%. We also have the PE ratios that back us up. You're looking at PE ratios at above norm, where we see price to book ratios for the internationals, particularly emerging markets, really, really cheap. And one of the things that we wanted to see is that the markets don't work in tandem as much as they have, and we're starting to see that right now, where domestic's going to go up, internationals will go down, similar to the fourth quarter. Domestics go down or not go up as much. Internationals can go inverse to that. So we're really pleased with that. One of the fun things that we like to do is talk about a restaurant, Jack's Cafe, a Minneapolis Northeast, Minneapolis favorite for over 75 years. They've got a great patio. Ashley's our newest employee, Ashley's mom or grandmother, her Texas bars are scrumptious. And a big part of what we want to talk about here is diversification. And quote of the quarter, diversification is one of those things that really isn't needed until it is. And that's really where we come into the equation and taking chips off tactically the table this last quarter. And again, don't want this to go unsaid. We thank you very much about trusting the All-Star Financial team, remembering our referral program. Everybody that you send our way that brings assets brings a benefit to reducing your costs. And we've got a great team here, and looking forward to a phone call to help you. And as we've mentioned, that we're here for you. We're fee only. We are here to make your life easier and to be as unbiased as we possibly can. Give us a call. Thanks for your time on this 2017 first quarter webinar. Have a great day.